Let's get started.
Mm.
This is session number 3 or day number 3. From previous classes, we managed to cover, let's see how far we've come. I believe we were able to handle this topic number 1, introduction. We were able to handle the trend analysis. We did candlestick patterns. We also did support and resistance, correct? So what I would like us to do today is to cover, today I would like us to cover trend lines, this one. I want us to cover supply and demand zones. I want us to cover pivot points, Fibonacci, retracements, and extensions. Those are the 4 things, if there's enough time, I would like us to cover. Okay, so this will be, these 3 will be our day 3.
Did we finish on the support and resistance?
Did I?
Did we finish on support and resistance?
Yes, and in the process of explaining the rest of the things, I'll be able to explain some things about support and resistance. In fact, trend lines are also support and resistance. Supply and demand zones are support and resistance. Pivot points are support and resistance. Fibonacci are support and resistance. Yes. So when we head over to the charts, I'll be able to show you what these things are. Now, as a recap, last time when we were talking about support and resistance, we did mention that resistance is always a level on your charts, or a level, a zone arranged in the market that has resisted the price from going up. Not once, but a few times. And we also did say, so that could be a resistance because price could not go above that level. This could be resistance equally because price could not go above that zone. This could be resistance because price could not go above this zone. Down here, this could be support because price could not go below this zone. And you will also notice price could not go above this zone, so it was resistance. But once it was broken, price could not go below it, now acting as support. Okay, so these things are zones, and from time to time, they keep changing. They may change from time to time. For example, if you see here, this was resistance, respected as support, but now price has shifted it down. You look at what was happening here, support was shifted to this zone here. Now it's respecting here, as you can see, as opposed to the high here. So sometimes market will keep adjusting its own levels from time to time. So that was a resistance. That was a resistance zone. I think up to here because you can see it was respected here. So I have to adjust it a little bit like that. But you see it has been broken. But here it was, you can see, was broke, it respected this level as resistance because this candle could not close above the zone. You see, that's why you need to trade with zones and not just a single line. Because a single line might cheat you like this. You know, if you didn't have a zone, you would have thought that this candle was a breakout candle, which is not, because the actual breakout candle was this. So it's important that you work with zones. So that was the logic. Now I remind you the rules we had last time for zones, because we did say not all support and resistance levels or zones are equal. Some are stronger than others. So we did list a number of rules to follow when you want to deal with support and resistance so that you don't confuse anything. We did say number 1, a good support and resistance must have worked as support and must have also worked as what? Resistance. So all you need to do is whenever you're drawing your levels, like now I've drawn this one as resistance. If I think this is a resistance because I think price went reversed, I need to go back and check, has it ever worked as resistance again? I realize yes. And I can still go back, I see whether it has worked as support. So if a level has worked as both support and resistance before, you can expect it to work in the future. Then we had a second rule that we did say that a strong support and resistance could be a swing. This could be a swing high or a swing low. Then what we were saying in this is if you see the highest level on your chart, for example, what I'm having on the whole chart, this is the highest level. That is my swing high. Okay. And the lowest level down here, that could be my swing low. So levels such as those are usually strong support and resistance. Then we said that a strong support and resistance would push price from that level further away from the level. In other words, when price bounces from the level, a bounce is this, we say this a V or something like an inverted V. In other words, price comes down, reaches your support and immediately changes direction and goes very far. Or price was going up, reaches your resistance and goes so far away from resistance. So we say that the move away from such levels, was so strong. So strong in two ways. Number one, it took long time for price to ever come back to the same level. Took long time. In other words, after meeting your support level, candles stayed away from the level for very long. So there's a time component. Number two, distance. Meaning, after bouncing off your support or resistance, the candles moved very far. Very far, whether within a short time or a long time, but the candles moved far away from the line. For example, look at this as this support. All these candles, look at the distance the price has traveled so far, very far. Okay, so and then we did say that you need to expect to see as a very strong candle, strong movement from those levels. How do you spot strong movement? From such levels, you expect to see long candles suggesting momentum. When you see long candles like this candle here, those candles are simply indicating there is momentum in that market. Long candles like this one, they indicate momentum. Momentum candles, strong. It means strong buyers, you know, strong sellers. So such are some of the things that will tell you that our level is strong. Our last qualifier that I did mention in our last session was that a strong support and resistance will be broken by a strong candle. Almost always, if you have a very strong support and resistance, it will only be broken by a strong candle. And a strong candle is usually a long candle, a long candle. Let me show you what that is. This was a support from previous level. Look at the size of the candle that broke it. This red candle, very big. Okay. Okay, let's move back and see whether that logic applies. Let's think of another level. This was resistance. All right? Resistance here. Look at the size of the candle that broke through the zone, a long candle. Look at the size of the candle that broke through the zone, a long candle. Almost always, a strong level will be broken by, let's pick a random number, a random level in the past. Here. Create that zone as resistance. What is the size of the candle that broke the zone? A large candle, okay? Almost always, that will be the nature of markets. If you think you have a good level, always check whether it has been broken by a long candle. Now here, this may not be a breakout. Now this is not a breakout. Be careful, this is not a breakout because this candle did not close above the whole zone. If this is your zone, this candle did not break above. If you think this was your zone, then you can say this candle broke above your zone. And then in the move back down, look at the candle, a very big one. In the move back up, a long candle breaks that level. So that's another filter for you to identify strong support, and resistance levels. I wanted to add one more thing that sometimes there are professional traders who don't just draw their levels. They just use an indicator, for example. There's an indicator that uses whole numbers. You trade using whole numbers only, okay? Now, support and resistance could be the ones we have drawn. Support and resistance could also be provided by round numbers. Round numbers. Now, round numbers are very important. Round numbers are numbers that end with zeros. Numbers that end with zeros, okay? Like now here we have 1.8450. You can see that. Here we have 1.18050, 1.17950. So numbers that could be like 1.80000. These are very important number. A number like 1.85000. This is an important number. A number like 1.85700. That's an important number. A number like 1.85750 is an important number. But in terms of importance, the more zeros a number has, the stronger is the number. So if you have a number with 3 zeros, it is a stronger support or resistance than a number with 3 zeros. And the 3 zeros will be better than 2 zeros. 2 zeros will be better than 1 zero. So let us test this and see whether it is actually true. Now look at the levels on the chart. The indicator, this is an indicator that draws this. You don't have to draw this. I've shared the indicator with you. It's called sweet spots. I shared that indicator with you in the morning before we started the session. It is here, the one called sweet spots gold. If you drop it on your chart, it will draw these lines automatically for you. All right? You know how to add indicators to your MT4, I guess.
Yeah.
All right. So once you drag it from your list here, it's called sweet spots. You simply find it, click on it, and drag it and drop it here. It will be able to do the work for you. So once you have done that, now all you need to do is see how this one works. Let's start from somewhere. It was able to get some resistance here and some resistance with these breakouts. Not accurate here, not very accurate, because I think the actual level is here. The actual level is here. But look at how it got this support here correctly. Look at how it got this resistance here correctly. Support, correct. Resistance, correct. Support is correct here. Support is correct. Resistance is correct. Some level of accuracy here. Support correctly here. Support is correct here. Support is correct here. Resistance is very accurate here. Very accurate resistance. Very accurate support. Accurate support. Accurate support. And not very accurate here. Accurate support. You see, it's getting most of those support and resistance levels quite correctly, quite accurately. Okay, and you would be able to trade with this. If you, for example, if you were to trade, this is a Euro USD 1 hour chart, you can still convert it into 15 minutes and see whether you can trade that. It doesn't matter really, you can do that 30 minutes. So it depends, but let's assume you're trading on the 1 hour, okay? So on the 1 hour, you can trade it the normal way. For example, you can just add 2 moving averages. Maybe you can add number 1, you can add EMA 50, okay? Add EMA 50. I can put it as a solid line, really. There's no big issue. Then you can add EMA 100. We don't need all the 4. Just those 3 are enough. Now, this is not EMA. This is SSMA. There's something I was testing. Okay. So, moving average 50 simple. Oh, no. It's supposed to be EMA. Okay, so if this is my trend, where did this trend start from? Somewhere here, I would say. So when this is the case, I'm looking for signals to buy only. Okay, signals to buy only whenever I bounce from a level. So remember, we are buying at support while we are going up. So market is moving up. it has not bounced from any support. Remember, if you cross this, if you stop at this level, if you are going up, this will act as resistance. If you break it and start coming back to it, that will be support. But I want my level to be touched by candles before I can consider it a level to use. For example, here, these candles were able to touch here. They gave me what? They gave me bearish engulfing, but because I'm in an uptrend, I am not going to sell. I am only thinking of buying. So if we scan the chart, you'll see the market crossed above that level, came back to that level, and gave us some signal here. Maybe you would have taken this inside bar. It's not a clear inside bar. Maybe you would have waited, and then you saw maybe this doji with this big candle to confirm that the market's actually moving up. Or maybe you would have waited for this candle to touch, form a bullish engulfing here. Maybe you would have bought from here. And if you buy from here, then you close your trade at the next round number. All right. So market goes up, breaks here, doesn't come back to give you a signal. Breaks above, comes down, doesn't give you a clear signal. But after breaking down and then breaking back up, you can possibly consider buying again. Here, it comes down, touches this number, no clear signal. Here we have a morning star pattern, red, a small green, and a large green. That's a morning star pattern. If you took that signal, maybe you would have made like 15 pips. Maybe the market went down 21 pips. But if you are able to hold the trade until the upper line, which is 45 pips, and you set your stop loss to be half of that 20 pips, that trade will still have lost. Because before making those 40 pips, it went down 35 pips. That would have been a losing trade. Now you have this doji forming at a doji or spinning top, actually, a spinning bottom at support level. Maybe you would have bought from here and you close your trade at the next line. That would have been a winning setup. There's no clear signal because price did not touch my level. There's a clear signal here, but I can't take this because the candle closed very close to the next level. You cannot take a trade, you cannot buy next to resistance. Please get that logic right. Whenever you want to buy, ensure the next resistance is far. Whenever you want to sell from resistance, ensure the next support is far so that price has room to move. So here your candle is very close to resistance. So immediately you enter, it's likely to bounce from here, start going the opposite route. So here we have a bullish engulfing from below the level to above the level, confirmed by this candle and confirmed by this spinning bottom here. You can buy from there and close at the next level. Same thing, morning star here, you buy, you close at the next level. Down here, I see this is like a what? An inside bar. You can buy from here, but you see now the risk, you have no space. So you avoid such setup. Here you have a morning star again. There's no clear space, so you should not risk such kind of setups. This is a better signal because you are almost like half. There's enough room. You can make 20-something pips. So there was room there. Now we switch to a downtrend. You start thinking of selling only. Now here you have one setup. What is that? Evening, not what? This is a bearish engulfing, candle one, candle two. So from there you can sell and you close it to the next level because there's gap, there's space. So that's how you can use this indicator for support and resistance as well. Now, what I like doing is I can use this indicator to help me pinpoint special levels. And I use those levels to trade. For example, if I see this round number was very close to a resistance, so I convert it into a zone like that. I leave the round number together with the actual place where market reversed from. Then come to this number, but I can see that the actual level was actually here, where the candles closed. All right? Or I can even add the lower level because also here, this was support. So I can create a range. So I see the lower number, it's here, but price actually closed down here. So I can create that zone. So you can do that and end up with creating very nice support and resistance zones for yourself. Candle, the round number is here and your level was down here. So if your candle doesn't break, your candle can break the round number, but it will stop at resistance, at your support level. Or it can break your resistance level, like here, but will stop at the round number. So you have two ways of identifying that price has come back to your zone. All right, so now one other technique we use to draw support and resistance. Now to remove this indicator, you have to right click, choose indicators, sweet spot, delete it. That's how it will disappear from the chart. Yeah, you cannot just try to delete it. It will not go away. So the other indicator I've shared with you is a pivot point indicator. Again, I've shared this with you. Pivot points, just drag it and drop it on the chart and leave it like that. Now, this is an interesting one. It's giving you, let me just indicator list, PZ pivot points. Let me remove midpoints. It's showing midpoints. I don't want midpoints. I just want the clear levels. Now, number one, let me first remove my moving averages so they're not confused. The way this one is drawing the lines, it is using the daily, charts. Look at this. As a large number of traders stick to pivot points, it's evident that the market reacts at these pivot levels. Now, pivot levels are special. They are special levels calculated, mathematically. They are calculated using previous day. In other words, you take the closing price, the high price, and the low price. The high price, the close price, and the low price. You add all of those for the previous day. Then you divide that by 3. Look at that. So when you see a pivot point, PP, pivot point, this line here, this white line, has been calculated using the previous day's price. So on the previous day, like today is Thursday, so this pivot point is calculated using Wednesday. The data for Wednesday is used to calculate a pivot point for Thursday. The data for Thursday is used to calculate a pivot point for Friday. So effectively, at the beginning of each new day, you have the pivot points ready because you use previous day's information to compute your levels. Now, this indicator does this automatically for you. You don't have to draw these things on your own. But just for you to be aware of what this is, it is based on information from previous days. So do remember that if I segment this into, I say show period separators, these vertical lines are showing me the beginning of a day, which is also the end of a day. So if you look at this was yesterday. This was yesterday. The high price, the highest price was here.
Yeah.
Okay. The lowest price was here. And the closing price was somewhere here. I mean, if I convert this into a single candle, what was yesterday? This red candle. Can you see that? That was yesterday. These are daily chart now. One candle is 1 day.
Yeah.
So if you take the high, which is here, you take the low, which is the bottom week, and you take where the candle closed. Remember, red candle closes down. And you divide that by 3, you will get a pivot point. So there are calculations around that. I don't want to bother you with those, but just know there are indicators that can draw these levels for you. And if you look at these levels, they also act as support and resistance. For real, they act as support and resistance. And there are professional traders that trade based on pivot points only. Okay? There are those who don't draw support and resistance, they just use pivot points. They just wait for market to go to resistance, give you something like a shooting star, they sell. Market will go down to a level like this, give you like a piercing line here. And if you think there's enough space, you can buy. Okay? So it works quite well. Like here, there is bullish engulfing. There's space to resistance, you can buy. And you can still, you don't have to close your trade here. You can let it go until you're going up until you are sure the market is reversing direction. Now that's one pivot point indicator by one producer or one developer. Let me show you a better version of it that draws horizontal lines instead of what you are seeing there. Okay. Now look at this indicator. It's also drawing pivot points, but they look better for me. Let me make it produce more levels. I don't know, so whether it's 100 or 1000. Yes, you see, I can adjust it to display, but they look neater than those that were curving. So this is also drawing pivot points, and the pivot points are also support and resistance. So a pivot point is here. You may not see that line. I've also shared this indicator with you, by the way. So all I've done is just adjust that this was 100 to 1000 so that it can display longer lines to the left if I want to test a few things. So starting from the left, you can see this level was resistance here was broken. Market has not come back to that level yet. It went to this level and was playing some games inside this level and this level. Came back down, went back to the same level, no clear signal. Went all the way to resistance, a clear signal here now. There's a minor engulfing or a kind of evening star if you consider this red candle, and this green candle. Now remember, evening star does not have to be what most textbooks would say. The concept of an evening star would be, we have a large red candle. We might have some small candles here that can be green or red. They can be one, they can be two. But then the end of, the end of it, this is, the first one is green. The first candle is a large green candle. Okay. We can have these ones as green or red, it doesn't matter really, but they should be small candles. Then the last candle is a large red candle. Okay. That is now the concept of an evening star. Now, if you understand that concept, then you would agree with me that if I combine all of these, I have an evening star. A large green candle with tiny candles in between, followed by a large red candle. That's an evening star. And we said an evening star is a signal that says you can sell. So you sell, you see the market moving back down. Then if you continue tracking the market, you would come to realize market goes up. It gave you a fake signal here, But again, you would not be actually trying to sell because we are in an uptrend if you look at it. You should not be selling. We are in an uptrend. You should be thinking of buying instead of selling. One of the things that you would have seen here is there is a red candle, a tiny green candle, a large green candle, is a morning star here. You would think of buying. And you see the market would have allowed you to trade that all the way up. So you see these levels work very well. They also work, look at this signal here, clear signal, shooting star at resistance. Morning star at support here. Morning star exactly at support. So you can wait for those clear signals. Again, there is bearish engulfing here, this and this, bearish engulfing, these two candles. There is bearish engulfing again, this and this. So this is bearish engulfing, but again, coming after a shooting star. This is a shooting star. The next red candle now makes the whole thing a bearish engulfing. Those are two signals saying the same thing. Look at how it becomes clear support here, clear resistance. Now breaks up and becomes clear support. So you can use pivot points as support and resistance. Now you need to notice this. A pivot point, the midline is the pivot point. Pivot is central point. The first level above it is resistance. The second level is resistance 2, resistance number 3. This is the center line, it's called the pivot points. Then below it, we have support 1, S1. Below it again, we have support 2, and below it, we have support 3. In other words, from the formula they used to calculate, pivot points, once you take the high, the low, and the close, you divide by 3, you get the pivot points. Then you divide the whole range into parts, and then you create the first part above it. Above your pivot point is resistance number 1, resistance number 2, resistance number 3. In other words, the assumption is when the market is near the pivot points, we are thinking of a ranging market. So if the market is above the pivot point, we assume we are in an uptrend. We assume we are in an uptrend. If the market is below your pivot point, which is the center, we assume we are in a downtrend. So how would you trade these levels then if you are someone who cares about trading the best way? So number one, when the market is moving above your pivot point is here. Okay? This is your pivot point. You're aware, PP, this is your pivot point. Now that we know the market is above our pivot point and we know this is an uptrend, what we need to do is we wait for market to break resistance. Break resistance number one, come back to it and give us a signal, then we buy. So we are trading in the direction of the uptrend. Then for you to use resistance number two, you may want to wait for market to go up and break resistance number two, come back to it as support, and if it gives you a buy signal, you buy again. So when you know that candles are below the level, we are sure that's a downtrend. So what you would do is wait for the market to go below your support, come back to it to give you a sell signal, then you sell. If it breaks this level and comes back to it, it will be acting as resistance, you sell again. That's one way of trading your pivot points. The other way of trading pivot point would be to use your own trend filter. You will not use the pivot point as an indicator of for trend. You would add, for example, your moving averages. You can add your moving averages. Maybe you will have your clear 20. This is the 50 EMA. You can also have what? You can have your 100 EMA, maybe red. So the moving averages are telling you the trend. Then you use these levels. Any of the levels will act as support. Now remember, when we are moving up, we are buying. When we are moving down, we are selling. So even if you were to look at this chart right from here, when the green line crossed above the red, remember, 50 is above 100 is an uptrend. 50 below 100 is a downtrend. All right. So already from this crossover here, from this level, the market is in an uptrend. So the first signal we get here is what? An inside bar of some kind. Or what you might call a piercing line, which is a buy signal in an uptrend. You can trade here and consider closing your trade at the next level or leave it to continue. Later on, we got bullish engulfing. This candle and this candle will give you bullish engulfing. That was another signal in an uptrend. So market breaks above that level, doesn't come. It breaks, that level comes back and gives you something like an inside bar of some kind also. You can also buy at that level. For a down movement here, the lines have crossed here. So you know this is now the beginning of a downtrend for you. You are looking for a sell signal. This is a shooting star, you can sell. This bearish engulfing, you can sell. Market goes below the level, comes back to the same level, you look for a signal, sell again. So any of the levels can be used as support and resistance if you are following the moving averages. Are we good to go?
Yeah.
Right, so now let me remove my pivot points and show you another indicator that can give you support and resistance. It's called pivot, it's called Fibonacci. It's called Fibonacci levels or Fibonacci. Okay. So we talk about Fibonacci retracements. Fibonacci retracements. Fibonacci retracements. They are also used to indicate where the market can reverse from, where the market can change direction from. Now, Fibonacci's, these are the numbers I created by some gentleman called Leonardo Fibonacci. The name is after somebody who invented this theory. Leonardo Fibonacci. It's not important to know those details, but he was working with the numbers and they came to realize a formula. Now, what you need to know is Fibonacci would operate from 0 to 100. And they divided these levels. There's a level here that is, I think, 23 point something, maybe 0.2. There's a level here that is 32.8. There's a level here that is 50. Now, I don't have to draw those things. Let me just draw it and I'll show you from there. Maybe I'm confusing those numbers. Okay, so the tool is here. On the left, you can see where my cursor is. When you hover over that level, you will see F. If you click that, you draw it on your chart like that. You see, starting from 0, 23.6, 38.2, 50.0, 61.8, and 100. So he picks a whole range, like when a market is making a swing, when a market is making those swings. Remember, we were drawing those swings last time. When a market goes high, comes back, goes higher, comes back, goes higher, comes back. So according to him, from here to here is supposed to be 100%. From here to here is 100%. But we know when the market goes up, it may not come back the whole distance it went up, like all the way back to here. Because, you know, we are talking about higher highs because the first high will be lower than the second high. And the first low will be lower than the second low. So market does not always retrace, like does not come back the whole distance, because if it did that, the market will always be bouncing like this, same distance. The market will always forever be in a range. But that's not the case as we know it today. So from the studies that have been conducted and from my own experience as well, while we have from level 100 to level 0 to worry about, the most important numbers when you are trading are 38, 50, and 61.8. These three. Those are the most critical numbers for a Fibonacci trader. Those. You can ignore this. You can ignore this. You can ignore this. There are other ways of using 100, and there's another way of using 100. But when you're trading pullbacks, when you're following a trend, when you're trading in the direction of a trend, the most critical numbers would be 38, 50, and 61. Some people would even say only 61 and 50 are important. So I invite you to go and try this and find out which one is working best for you, because traders are very different. So how do we use this as another way of confirming a support and resistance? There is only one way of drawing this and get it right, because on the internet, there's a lot of confusing information on how to draw this. To use a Fibonacci tool, all you need to draw is draw it from the left of the chart. Draw it from left to the right, period. Don't be confused by people saying, in an uptrend, you draw it from the low to the high. Okay? And they say in a downtrend, you draw it from high to low. That can quite confuse sometimes because people may not understand these lows and highs. All I say is, regardless of the trend, draw it from left to right. I will show you exactly how. So this is a market that's moving up. Let's say you started from this level. This was your support. Market has gone up to this level and has started coming back. You have seen one candle, two candles, and you're wondering, how is it, where is it going to stop? Where is this movement to the downside? Because remember, in an uptrend market, it's supposed to be going up. So when you see it trying to come back down, you want to see where is it likely to stop so that I can buy and continue moving up. You drag this thing, click it, put it at the lowest level from your left. Move it to the highest level where market changed direction from. Here, on this candle. Are you seeing that? We started from this candle, the lowest. We have gone to the highest on this candle. You drop it there. You realize market has come back, has broken 23, is now at 38.2. On the right, can you see 38.2? Can you see 38.2?
Yeah.
Maybe I should bring the lines closer to you. Can you see 38 here? This is where the candle is today at the moment. But it didn't just stop at 38. It went down to almost near 50. Look at the wick. So this candle is between 38 and 50. After that formed, what is the next candle? Green. Combine this candle and this candle, what pattern do you get? Bullish engulfing. So when you find a bullish engulfing forming at 38, 50, or 61.8, that could be a good signal. Any reversal pattern of all the candlesticks we studied last time, if they form at 38.2 or at 50 or at 61.8, you might want to consider that as a nice trade. However, I will advise from the beginning, do not trade Fibonacci alone. Don't pick a signal because of Fibonacci alone. Fibonacci is a supplementary indicator. Use it in combination with support and resistance, in combination with the round numbers, in combination with the trend lines, in combination with other tools like pivot points and the moving averages like this. Remember also, moving averages are support and resistance. I told you that last time. For example, you see this pattern forming on, this bullish engulfing forming on EMA 50 and 100. And this is very common, it's everywhere. You see, 50 is below red, a downtrend. Price goes back to all of them and gives you a bearish engulfing, you can sell. If the market is above, now market is above, let's pick some signals from the beginning. We have the beginning of an uptrend here because the lines were very close, now they're beginning to expand. Bullish engulfing, you buy. Bullish engulfing, you buy. Market comes here, bullish engulfing, you buy. There's a range when candles are in between, but it gives you a morning star here, and you can see markets going up. Morning star, markets going up. Piercing line, markets going up. Bullish engulfing, markets going up. So even this is support and resistance as well. So for example, now you were here. The market has gone up to here. Or you were here, the market has gone up. So let me show you how you can plot your levels. So click Fibonacci, put it here at the beginning and here. Maybe this is the last candle. So you've seen the market has started going down. So when the market has started going down, that's when you draw. You don't draw, this candle will be here, by the way, because the market is still moving down. Or maybe you were drawing it from elsewhere, maybe here. You wanted to see how far the market would go down. 20 to 23. I don't like 23. Here, market came back to between 23 and 38. You are not happy with that. Maybe the low was here. You can adjust your level. You start from here, you move your level to here. Then you realize we are at 38, exactly at 38. And we have a morning star here. Market's going up. Or you can draw it from here to here and see how far the market can move down. Market went down to where? 23. And later on to 38, and they gave you a bullish engulfing at 38. You can buy. So you need to be conversant with how to draw. Now I want to draw it from here to here, so that I see how far the red candles could go. Then I do that. Then the candles came between 38 and 50, and they gave me a signal from there. You can see doji, or spinning bottom, and that's also a bullish a bullish signal. Later on, look at this morning star. Where did it form? The morning star touched 61.8, touched 50, and was below 38. The entire morning star. Then you can buy from there. So, but this signal would be better if you have another level like a moving average. Now we have moving averages, okay? If you have a pivot point, if you look at the back, you can see this was a resistance. Can you see that? That was a resistance. Resistance now acting as support. Can you see exactly that? All right. So we drew this line and we were able to spot this bullish engulfing. This bullish engulfing, if you check in the past, maybe it was a trend line. I think it was a trend line support, like that. There was a trend line or the moving average. So you can use a pivot point to do that. In a downtrend, you'll draw it the same way. In a downtrend, you draw it the same way from left to right. So let's find a downtrend. Now a downtrend is the market's moving down. So you start from here to where it changed direction. And you want to see where is it likely to stop. So you drag it from here down to here. Market went all the way up to 61.8 and changed direction. And if you look at 61.8, it was a support before. It was a support before. So when you see a level is support, and as a Fibonacci 61, or a Fibonacci 50, or a Fibonacci 38, that level is stronger. As a matter of fact, that's what we call confluence trading. Confluence trading. In other words, so many signals saying the same thing. Fibonacci is saying that is a support, or in this case, Fibonacci is saying sell, because you are at a very important level, 61, 50, or 38. So Fibonacci is saying sell. The moving averages are saying sell. Support and resistance is saying sell. So that's what we call confluence. Many things coming together, many signals coming together. Great. So that takes care of Fibonacci, and that's how you draw it in a downtrend or an uptrend. All you need to know is when the market is changing direction, you just need to follow it. You just need to follow it. In a downtrend, when market is doing this, going down, going back up slightly, going down further, going up slightly, going further down. So all you need to do is you will be drawing your Fibonacci from this level up to the other level down. So you're waiting for the market to go back up. Remember, in a downtrend, you want to sell. So you wait for market to go up to important levels like 61, 50, 38. Then you look for a sell signal like a candlestick pattern, and then you sell. Or you wait until you get an important level like 38, 50, and 61 together with a resistance level that you have drawn on the chart. This resistance level could be a pivot point, or any of those pivot points, resistance 1, resistance 2, etc. This could also be a trend line if the market was making those trend lines. I'll show you what they are. Or this could be a round number. Okay. Now, you may want to see that clearly. I will show you that right away. I don't want you to have any doubts about this. So let me give you an example. Let's bring back our pivot point indicator. This one. Let me increase the number so that you can display more to the past. Okay. So look at the chart now. Market has moved from here, has broken my support, has broken this level, has not come back to it, has broken this level, is yet to come back to it. So it has gone all the way up, and I can see it beginning to come down. I want to see whether it will stop at support level. Remember, we are buying at support level when we are uptrending. So, but I want to see when my price comes back, when market comes back to this support, do we have an important Fibonacci number, 38, 50, or 60? So I pick my indicator, I draw it from the low here all the way to the other side, up. And I wait. It came back to my support level. Can you see that? This was our support by the pivot point indicator. So it has come, the candles have come back to support level. But if you look to the right, here, where are we at Fibonacci? Between 38 and 50, which is correct for us. 38 and 50 is good, because 38 is important, 50 is important, 61 is important. So anything between 38 and 61 is good. If it goes below 61, you may not want to trade that. If it's happening above 38, it may not be important. So the most important zone is the one that is inside where? The most important zone is this. That is the most important zone. Let me show you what that zone is. Everything here. From 38 to 50 to 61, if you get a signal inside here, and we have a support and resistance level there, or a pivot point, or a round number, that signal is good. Okay, so I think that helps you understand how to combine Fibonacci with other indicators. Even round numbers, you can use them the same way. So if it were downtrend, again, you would do exactly the same thing. Fibonacci, you have to double click on it and remove it. Right click, delete, then it will go away. Let's find a downtrend and we apply the same indicator. So here, so now, do we have our pivot point showing that far? I don't think so. Our pivot point is not going that far. So let's maybe use a different currency pair USD card. Maybe we have a downtrend here. Very good. We have a downtrend on this. So market has moved from here, is going down, has broken this level, has gone back. You can get your first signal here as a matter of fact, but I like seeing several candles coming back before I can qualify a signal. So I can pick it from the high to where the market started changing direction upwards. And it comes back to where? Between 38, 50, and 61. It actually touches 50 exactly, giving you something that looks like a shooting star, more like a shooting star. At 50, and where is that level? Is also as pivot resistance. You can see this is support 1, but support broken becomes resistance. So that becomes a powerful signal. Later on, when I show you how to add trend lines, you will see there was also a trend line. So we have resistance from the pivot point. We have resistance from a trend line. We have resistance from moving averages. We have resistance from Fibonacci 38 and 50. And we have a bearish signal here, inside bar, or something like a hammer, a shooting star, or 1, 2, 3 candles combined, they give you an evening star, and the market goes down virally. Great. So we leave that for now. We do away with these levels. Go back to our pair. I like using Euro USD most of the time for demonstration, so you understand why. Now, along the way, you will notice that in our course content, we were to talk about trend lines. So let's talk about trend lines. And then we talk about supply and demand zones. Okay. So trend lines. Trend lines are lines that move like that. When the market is making higher highs and higher lows, you connect the lows to create an uptrend line. When market is moving down in a downtrend, when it's making lower lows and lower highs, you connect the lower highs to create a line that's moving like this. You use the points, remember? We use the highs, the lows, the lower highs, the lower highs, the higher highs. Those are the levels we connect. So like from here, this is a downtrend. In our downtrend, if you look at it, the market was making this high, a lower high, a lower high, a lower high. Is that correct? So then you should be able to connect those levels with a line. You just need to connect one high with another lower high. You create a trend line like this. Another example. In a downtrend, once again. If you think this is a downtrend, then that's fine. This is a high, a lower high, another lower high. So I just need to connect 2 of them, and they give me a nice slope. So I can connect that with this. High, lower high. Then we go here, high, lower high. I can connect them. And you can see market reacted here. Let's go another case. And see a nice trend. There is a high here, another high here, but they are all moving down. I can connect with those 2. I just need 1 point and 2 I connect. You see how the market reacted here? How the market reacted here also. For an uptrend, you look for low, a higher low. Low, a higher low. Then you connect those 2. And extend your line, hoping the market will come there in future. Or you connect this and the next higher low, like this. And you see the way the market is bouncing from here also. More examples. In a downtrend, you have this, you can connect them like this. Swing high, market reversed from the next point. Here you have this and you have this, you can connect them. It was broken. But that's how you draw them anyway. So here we have 1 point and another point. You can connect them like that. 1, 2, market comes back to the same level later. Then you can also connect this and this if you want. It can be respected or broken. Here, it's not respected, it's broken. Respected when the market stops and prints a green candle. That's when you know that the market has changed direction or has started to change direction. But when you see red through the line, it's a breakout. Here, you can connect this and this. Now, in effect, what we are saying is the lines must be sloping upwards. When you are in an uptrend, they must be sloping downwards when you are in a downtrend. Like now here, you can connect those two. Body. There's a body here, bodies of candles, body, you connect the lines. Okay, those are downtrend lines. Body here, you can connect. Market comes back to the same level and respects it. Later breaks, goes above it, comes back, respects it. And many things can happen. So it's important to be familiar. In an uptrend, just connect any two levels, this and this, then you connect that. Now, in case you have a problem doing that, you remember the fractal indicator. Under indicators, Bill Williams fractals. Push it on your chart and connect any two fractals that are a good distance apart. So if I see, for example, in an uptrend, let me see a good uptrend. I see this a fractal and this a fractal. I can connect those two. And I wait for market to come back. Sure enough, market came back to the same level, gave me a piercing line, and I can buy. If I see this fractal and this fractal, I can connect the two and wait for market to come back. Bullish engulfing, I can buy. On the trend line now. For a down move, the same thing, just pick a fractal and connect them. Fractal, goes back, comes back inside with a, what is this one called? Dark cloud cover. Remember, dark cloud cover closes below half of the previous candle, 50%, remember? That gives you a sell signal. So that's how you can draw these things. You can use fractals to draw, or you can draw them manually. You can like connect this and this. There's a fractal here, there's a fractal here. Connect the two and wait for the market to come back and give you a signal. Market broke above it and then came and broke below it. And if you feel like, okay, you didn't draw it correctly, and you can also think of drawing this, connecting this level together with the next level, like this. And maybe the market did not respect it, broke your level. You can adjust it and connect to the next level. You can keep adjusting. Now you connect it between this and this. Sure enough, after market went up, gave you a shooting star, telling you possibly market going down, printed a down candle. The combination of the three is what? Evening star. You see that? Or maybe you combined this level and this level to draw your line. Okay, this fractal and this fractal. You see how the next market stopped at the level and gave you a nice signal here, shooting star here. So you can, that's how you do trend lines. Now, after you have done your trend lines, you can even trade your trend lines with the Fibonacci also. Nothing stops you. You draw your trend lines and you can also play them with Fibonacci. For example, from here, I can see the market is moving up. Can see the market is moving up. If I were to connect from this level all the way through this candle, then from this level, I want to see where Fibonacci is. From this level, market went as high as there, comes back to this level. Which level is that? This is 50. 50. 1, 2, 3, morning star. I wait for the market to close above my trend line, I will buy. When I'm using a trend line, I want to buy only when market is above the trend line. If I'm using the trend line on a downslope mode, I expect my candles to be below. Like now, when the candle closes below the level, I can believe the market will continue going down. That is it about trend lines. Trend lines are very powerful. There are people who trade trend lines alone. As a matter of fact, you just randomly, like now, I don't know. Let me go back on 1 hour, on 4 hours. I don't know what's there in the future. Let me see whether I can draw a trend line, and we see whether it can be able to help us in the future. Number one, I connect that and this. I don't know how far this line can go. Let me just enable it to go far by under parameters ray. It will stretch. So if I follow it, it was broken, acted as support. Very nice. Let me do another trend line. I think this and this looks like a very nice level. Connect those two, here and here. But remember, we are in a downtrend, so we should not be thinking of what? Buying. We are in a downtrend. So let me get one for a downtrend when we are where we are in a downtrend. So let me randomly move and stop somewhere where I see a nice slope. Then we are starting an uptrend, so maybe I can do it from here. Sorry. Maybe I can do it from this level like this, from this candle to this candle, and wait for market to come and react. Market comes here. I told you I only buy when market is above the trend line. So from here I could buy. After the market goes back up, I can buy. Or I can buy from this bullish engulfing candlestick pattern. In a downtrend again, randomly stop. The lines are quite accurate, like support and resistance. Even when you see they are far like here, you can still drop your line and see what can happen here. This and this. As long as you're in a downtrend, you can consider a signal. Oh, unfortunately, it's coming when we have an uptrend. A better one could be where? Let me see. Can we capitalize on a nice uptrend? There's a downtrend here. Maybe I'm seeing a downtrend. I can connect this and this point and this point. Market reacts here, and then breaks. Okay. For uptrend, I see this happening. I know this is a point and this is a point. Can draw my line. Market breaks below it. No signal here. Respects it for a while. Now begins respecting it. Remember, acting as support, broken resistance, broken support, 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 broken resistance. And I just dumped it on the chart. I didn't quite try to do it accurately. I'm just trying to be, if you do it very accurately, it can give you very accurate results, as a matter of fact. It can give you very accurate results. If you do the bodies and you do the wicks, you combine them, you create a zone. That's a zone, that's a zone. That's a zone. That's a zone. Markets reacting to that. So again, trend lines are powerful. The next thing I want to show you is what we call support and demand and supply. Demand and supply. Now, demand and supply is almost like support and resistance, but we draw it differently. To draw a demand, now remember, the market moves up because of demand. The market moves down because of supply. So this is how you draw this. I will not show you all the cases. Some of those you will find in other materials to read. If you see a candle like this, but before it, there was a tiny green candle, a small green candle, like that. Then you can draw your zone like this. Oh, it's a bad color. Then you can draw your zone like that. In other words, the green candle is small, the red candle is big. So you take the whole body of the green candle and So the high, you take the high of both candles. There was a wick here, there was another wick here. If that was so, then the line could be there. You take the high of the two candles and the open price of the green candle. That's why you draw your zone. The reverse could be true if you have a green candle here, a small one, or a larger green candle, sorry, like this. But before it, there was a small red candle like that. So to draw your demand zone, you would now do this from the low of both candles and where the red candle opened from. That becomes your zone. So let me give you several examples, maybe. Look at here. So we have here, the green is smaller than the red. So this is where the green candle opened. This is where the green candle opened. And this is the high. This higher is higher than this. So we do it like this. So the whole of this is called a zone. This is a supply zone. A supply zone is the equivalent of resistance zone. So here, when candles are inside here, you don't trade. When candles break outside the zone, you can trade. For example, you can ignore all those signals until you see a signal that is outside the zone. For example, which pattern is forming outside the zone? This pin bar, shooting star. Rejecting the zone, then you can sell. But candles inside here will give you a lot of false signals inside the zone. Let me show you a support at a demand zone. Look at this candle. Market has been coming down. It gives you a small red candle. Put the line at the open of the red candle. The red candle opens here. And the low, the lower low of both. This low is lower than this. So that becomes your zone. When the market is inside here, you don't do anything. When it breaks above the zone, you can trade. So you see a bullish engulfing. Market breaks above the upper line. As the candle has broken above the upper line, a few pips above it, you can buy your trade. And let me give you a few more signals. Sometimes you can combine several candles and get a zone. Let me show you an example again. For example, we have green, 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 small greens, but followed by a very big red candle. You see that? So you can assume this red and this red combined is one long red candle because they are following one another. As a matter of fact, from math, candlestick mathematics, if you have a candle like this, followed by a candle like this, these candles combined will give you a long candle like this. Okay? That's the meaning. This, okay, let me give you an example. This could be a 15-minute candle followed by another 15-minute candle, okay? If you are on 15 minutes. But if you go to 30 minutes, a 30-minute candle is the same as 2 candles from 15 minutes, correct? So on 15 minutes, you saw 2 candles looking like this, but on 30 minutes, you saw 1 candle that looks like this. Okay. So that clearly says you can also combine these things. So in this case, what I would want to do is I will take the high here and I will take the low of the body of the greens. So I'm interested in this small green and this small green, or even this one. It's where the green candles were opening. And this is where the high is. This candle broke out of that. So this becomes a zone. When market comes back to that zone in future, I would want to consider taking a trade if I get a signal. You see, market comes back to the zone and stops, goes down. Comes back to the zone and it gives you a bearish, this is a bearish signal, this is a shooting star. So you can sell if you know you are in a downtrend, but clearly this is an uptrend, so you should not sell. You should wait for this zone to be broken. Market comes back to that zone. Now remember, a resistance, a supply zone when broken becomes a demand zone. All right. So that's how you should be looking at these things. So sometimes you don't have to use those long candles. Sometimes you can get a small candle and you can use it to draw. If you get a candle like this, it's a very small candle, okay? So in this case, you can just place your line here and at the wick, not at the body. It's a small candle. That becomes your zone, you see? you get a signal immediately on top of the zone. But if the price comes inside the zone and breaks outside the zone, here you can trade. But inside the zone, you don't take the signals. You take a signal only if the market moves outside the zone. Like this, a morning star that has closed outside the zone, you can buy. A bullish engulfing that has closed outside the zone, you can buy. Okay. Final example for demand and supply. Okay. Sometimes you can also do the opposite. Actually, I think I gave, there's another example here. You can combine this red to make one big red, but there's a small green here. You follow that, you would see it was an important zone in future. See? That's why I was saying, unless the market breaks down the zone, don't trade. So if you saw this signal, you try to trade, the market was bouncing inside here. But now you see a bearish engulfing that closes outside the zone. Now you can sell. Or you see bearish engulfing here again outside the zone, you can sell. Depending on your trend. Remember, you only do these things if you are in a downtrend. Great. So that helps us close that part on demand and supply. There is something I did not tell you about this. Fibonacci extensions. You will notice that when you draw Fibonacci on your chart, look at that carefully. I don't know how to do it so that you are able to see. Now, we only looked at 0 to 100. But if you draw your Fibonacci properly, you'll see there is 161.8, 261.8, 423.8. Now, numbers, Fibonacci numbers above 100 are known as extensions. Extensions. In other words, we assume this. The market is supposed to be moving like this. Move down. Now I have to change this thing. I remove this red thing that's making it stretch. The market is supposed to go down, go back up. All right? And bounce from here and then continue going down. If we are actually in a downtrend, that's how the market should behave. Should go down like this. And then go slightly back up. Then continue going down in a downtrend. But there are cases where the market will just make a move in a downtrend like this, but the next candle will not stop. When market goes up, it doesn't stop at 38, 50, 61, 100. It just continues, and crosses 100. So remember, you start from 100 and you close at 100. If you have looked at how we draw Fibonacci, where you start from is marked as 100. Just see. I'm drawing it from here. So mark this point. What is the point here? 100.
100, yeah.
So in other words, if the market moves from your 100 level, goes somewhere to 0, because the last point is 0, and comes back to 100, it's like there's no movement. It's like you have gone to Mombasa and come back to where you started. You know, they say in physics, that is what? Is it no work done? If you move from A to B and then B to A, it's like no work is done. I don't know. That logic was interesting. Whether it was no work done or no energy spent or something like that. So anyway, so market started here, went all the way and came back to the same level. Effectively, there's not much you have done. But there are also cases now where you would say now, if the market comes back to this level, it means if it breaks 100 and goes below 100, that is now a reversal. A reversal. A reversal. Now we are almost heading to this. We are heading to reversals and trend continuation. But I'm just mentioning it for now. So a market is supposed to do this. So you better understand that correctly so that it's not confusing in any way. The market in an uptrend, the market is supposed to make a high, a lower low, a higher low, a higher high, a higher low, a higher high, a higher low. Okay? So the market is not supposed to make a high, come back to the same low, go back to the same high, go back to the same low. No. And from here, if the market goes up, And then now the next low is lower. Now that trend is finished. That trend is no longer existing. Because it has now destroyed the structure which is supposed to be higher high, higher high, higher high. Now it has made a lower high. Now, if you make a lower high, you have started a downtrend. So the level that was broken can now act as your resistance. So market goes back there, you expect it to start pushing the market down. Now, if the market goes back to the same level, you expect it to continue going down. So how we are using this Fibonacci retracement tool and how we are using the extension is, in case the market goes back to zero, breaks your 100 down, now I would want to imagine it may not continue all that route. Maybe at 161.8 now it will reverse. In other words, if all these points failed, you can expect it to reverse from the extensions, the extended numbers. Because 161.8 is 100 plus 61.8. Remember, 61.8 is important.
Yeah.
So let's see whether we can get an example. Extensions, I don't commonly use extensions myself, but it's a concept that other users, other traders use, and you're likely to come across it maybe in the course of your trading or studying. So let me see a good trend. Now, like from here, I start from here. I see the market has been going down, 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 down to this level. And I want to see where is it likely to reverse from. Then I follow it. Market breaks 100. I explain this. If it breaks 100, it means now it's a reversal, not a continuation of the trend. Now remember, we were moving down, so we were hoping to sell. But if we break above 100, the downtrend is dead, so we are starting an uptrend. So market comes back to the 100 that it has broken, and the uses it as what? As support, and goes back up. It breaks 161.8, and later on comes back to it as support. That may not be a very good example. Let's see whether we can get another one. Maybe this one. Which one here? I don't think this one is a good example. Maybe. The 1 hour chart. Let's try there. Okay. Maybe you were picking your trade from here. Market goes back down here. That will not give me what I'm looking for. Yes, that one will not. This one is not. This one is not giving me the results. I may not be able to get what I'm looking for to illustrate my point here. From here, maybe market goes down. Good example. You get a good example here. So you saw the market go down from here, but you have seen it break your 100 and going up. And you're asking, where is it going to stop now? Because for sure, now that means the market is going to change direction. So it has broken your 100. It means don't expect it to go down immediately. It has to go further up. But to where? It goes back to 161.8. Exactly, like you can see. 161.8 here, and stops and reverses. Now, if you look at it carefully, let me extend the line. I'm supposed to extend with this. From here. So stopped here. Later on, where did it stop? Exactly at the Fibonacci number 261. Can you see the magic? Goes further up, breaks a level and comes back. Where did it stop? 400 and Fibonacci is funny also, but like I said, don't use it on its own. For sure, if you combine it with other tools, you'll be a better trader. For example, before I trust this level, I have to check whether it was an important level before. Was it? Yes, it was a resistance before. What about this 100 that was being respected here? Was it a level before? I can see there was a support before or a resistance before. So I have a nice level there. What about this other level that's also being respected here? Was it actually a level before? other than Fibonacci. I go back. Yes, it was a level. The further up, do we see any other number? No. So those are the extensions. Generally, let them not worry you. I personally don't use them much. I like using the retracements because I like following the trend. I don't want to chase a trend that's going in the opposite direction. So what we had today, we had Fibonacci, retracement and extensions, that's fine, covered. Pivot points, covered. Supply and demand zones, covered. Trend lines, covered. So, God willing, in our next session, we will talk about breakouts and pullbacks, reversal, and trend continuation. Okay? Meanwhile, do you have any questions for today? Any questions you have for today?
No, not yet.
You don't have any for now?
For now.
All right, then, if you have questions, I'm encouraging you, please ask me questions. This is the time you have to ask questions. Yes. All these things we are studying, go back to your MetaTrader 4. Try to play around with them. If you are not getting something clear, send me a message on Telegram.
Okay.
Or keep them. You can send me screenshots, just like maybe you are not sure whether these are an evening star, for example. You can take a screenshot, maybe surround this number and type a message here. Is this an evening star? Maybe you are drawing your levels and support and resistance. You're not sure. You can draw a line like this. Maybe the chart looks like this. Maybe you've drawn a line like this, and you can now ask me, is this proper resistance? Is this a good level? Or maybe you are drawing a trend line and you've drawn it and you're worried whether is this correct one, like now here. You have drawn using the wicks, or you have drawn using the bodies, or you have combined a wick and a body. On one side, you have used a wick. On one side, you have used a body. You should be asking me, is this the correct way? Such kind of things. Okay? You have seen a very long candle, like this and this and this. This is like an evening star. Just ask me, is this a good evening star? And I can tell you it's not a good evening star. If you see a very long candle, immediately after a long candle, market reverses. You can check your chart almost everywhere. After you see a very long candle, the market changes direction for some time. Long candle, market changes direction after that. Long candle, market reverses for a while. Okay? Long candle here, market changes direction. Just check all the longest candles you see on your chart. Long candle, market reverses. We call them exhaustion candles. The market is tired. Try to push, try to push. Now used all the effort, pushed again, market reverses. Used all the effort again, market reverses. That's the logic behind it. Okay, like you see small, 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 then very large, market reverses for a while. Yeah, small, 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 then very large, market reverses again. So you don't see those candles, and this is where people get messed up. You see small candle, then a large candle. Say, oh, everyone is buying, you buy. The market just reverses on you. You see the market was coming down, small candle, oh, a large candle. I think now people are selling. You sell. Sooner or later, the market just goes the opposite. So don't be excited by long candles. When I see a very long candle, I get worried. Because a long candle, I told you, breaks a level. When you see a long candle, support is being broken or resistance is being broken. Many times after breaking a support or a resistance, there is a pullback. Pullback. We'll be talking about this tomorrow. Pullback. Market comes back. Because when you see here, when you see what's happening here, buyers have used a lot of energy to break this level. So after using all the energy, the bears or the sellers are stronger now. They'll move the market back to where? Here. Same thing here. You see this very long red candle. It's breaking this level. But after breaking this level, they have used a lot of energy. Buyers will come in for a few candles. They will try to come in. They will always try to come in. Same thing here. You see a long red candle here, a long green candle. Buyers used a lot of energy to break this resistance. Sellers came back for 2 candles before market continued. So in case you see an extremely long candle, then don't jump in. Here is one. Here is one. Don't jump into the market. A long candle like this. Very long. Actually, it could be the longest red candle in the entire chart from the past. You place a trade here. Market goes up to here, spikes back up and hits your stop loss, and you're out of the trade. So try to be careful of those crazy candles. If you see a candle like this, most likely this was news. When people are announcing news, maybe Trump is speaking or something is happening in the market, the next thing you see is market becoming volatile. Volatile meaning it doesn't know what to do first. It's just reacting. Some people are selling, some people are buying, confused. All right? But later on, you'll understand through volume analysis that this is how professional traders cheat. They cheat. They cheat others, that they are going down. So by the time this candle is moving like this, like this, like this, people say, oh, it looks like we are selling. Everyone is selling. This is a very nice move down. Maybe you catch it here. You catch a trade here for sell. The candle is still moving. Then you sell, or you see it move down and they're happy. Oh, now, a nice one. Then slightly before the time, before this candle closes, whew, back up. Here, whoever placed a stop loss here is out. Stop loss here, out. Stop loss here, out. Stop loss here, out. Everyone is out. That's why you hear 90% of traders lose money. All right, so let's leave it here for today. I think we have covered much ground for now. I really expect that you have started seeing markets from a different perspectives than what you have been learning online, being thrown here and there by everybody, and you're not able to ask them about. So when we talk about breakouts and pullbacks, reversals and trend continuation, you will start seeing a very good way of looking at the markets as a professional trader, not just a gambler. Yes, because now this is what distinguishes people, traders. Like now, many people trade reversals. Most of the people who lose money trade reversals. The few who make money, they trade continuation. That's what I've been telling you. Follow the trend. In an uptrend, only buy, don't sell. In a downtrend, only sell, don't buy. Because it's so simple. If you look at it, when the market's moving up, from here to here, you can make more money than trying to go down. Why? Even if you try to pick a trade from here, you don't have to close it here. You can let the market continue going up to that point. You will make 80 pips. Now, everyone who is trying to sell, reverse a trend, because the trend is up, but they're trying to sell in an uptrend, can only make 20 pips and be stopped out. 20 pips and be stopped out. 20 pips and be stopped out. But if you pick that trade from here, the first trade will be 80 pips. If you didn't close the trade at any level, another trade here, it would also be 70 pips. Another trade here would also be 70 or 80 pips. Another trade here, maybe this one would lose. But again, no, because stop loss is so low, 10 pips. This one would also be a winner. But a reversal trader would pick here and lose, or close with 10 pips. So maybe 10 pips, or 15 here, 15, 15, 15. Total 60 pips. But the other person was grabbing a lot of pips here. Even one single trade could also afford that much. So even if you were to close at resistance, this is how you could trade this. So you know you have a resistance here. Okay. Maybe you have another resistance here. Maybe you have another resistance here from the past, you don't know. So when you buy here, you close at resistance. It's about 20 pips. You buy the next one from here, you close at the next resistance. 20 pips, 40 pips. Now you know your resistance is here. You buy from here, you close here, 30 pips, all right? Now, if you buy from somewhere here, later on, you know that this is your resistance. So you could buy from here towards the resistance if there was an opportunity, but I think the trend is changing direction. So in a downtrend also, you only sell. It's from the diagram I've been drawing quite often. You should be familiar with it now. In an uptrend, we have always been saying market will go up, come back. Okay. Go back up, come back. Go up. And if you look at it, the move up is longer than the move down. The move up is always longer than the move down. In other words, if you are buying when the market is trending up, you will make more pips than if you try to sell. You will make more pips. If you make more pips, you are making more money. Okay. Conversely, in a downtrend, the market moves for longer down, but a short period up. Longer down, short period up. Longer down, short period up. Now, reversal traders, these are reversal traders here. These are reversal traders. They are trying to reverse the market. But this is continuation. Continuation, those who follow the trend. So here you make 60 pips, this guy makes 20 pips. Make 80 pips, this guy makes 15 pips. So that's how you should be approaching the market. And I hope that will be our next session, God willing. Oh, we are almost doing 2 hours. That means we are able to close our course even before the 10 days are over.
Okay.
Very good. See you in the next session tomorrow, God willing. Let me convert this video and send it to you so that you can watch.
I can watch.
All right.
Thank you.